This is worrying for inflation to be picking up for 3 straight months, but you think this is hardly surprising. Why is that?
Absolutely. In fact, one would almost expect to see this sort of rise given the kind of pressure that the currency has been under. Now, we do know that a lot of the depreciation of the Ghana cedi took place in the context of very little foreign exchange availability. The interbank market for the Ghana cedi for foreign exchange hasn't always been trading smoothly, hasn't necessarily always been open. Nonetheless, the extent of the pressure and the rapid feed-through of exchange rate weakness into producer inflation, we think is a signal of what to expect in terms of CPI. A few qualifications are needed. There hasn't necessarily always been a robust relationship, a stable relationship that will hold between CPI, consumer inflation, and producer inflation in Ghana. But what we do know is that the broad direction should certainly be something that's important. And if we're seeing this level of pressure on producer inflation, there's every reason to anticipate that it's just a matter of time before consumer inflation still starts to rise more strongly.
Because food inflation is already up. The government's target, the central bank's target, is about 8.5%. And in fact, it has raised its rate by 200 basis points. But do you think this will help at all?
Well, we've seen a range of tightening measures from the Bank of Ghana. So we had seen at successive monetary policy meetings, at each of the last 3 meetings, the Bank of Ghana has raised rates, a total of 250 basis points. The real tightening, however, took place in terms of the other measures that the Bank of Ghana has put in place. So, for example, having noted a rush towards dollarization, the preference for holding foreign currency in the economy, the Bank of Ghana required that the statutory reserve, even on foreign currency accounts, be paid in Ghana cedi. We've seen the reintroduction of short-term bills to mop up excess liquidity. We've seen a range of other measures that have effectively meant even more in terms of tightening than the rise in the policy rate alone. Now, of course, when we look at bond yields, those have backed up very significantly. Ghana has amongst the most attractive real rates of interest of any frontier market, and that has, of course, elicited some response from foreign investors. With yields this attractive, it would be unusual not to see some interest in the Ghanaian bond market. What we haven't yet seen, however, is enough of an inflow to calm conditions in the foreign exchange market. This is still a market that trades only very intermittently. Everyone's still looking for more to happen, perhaps more intervention, more foreign exchange selling by the Ghanaian authorities before this exchange rate is likely to stabilize.
Because there's also a lot of forex volatility. The Ghanaian cedi is the second worst performing currency this year, down well over 15%. How does all this new data inform your thinking?
Well, that's a very good question. First of all, on the GDP. If we're looking at GDP in year-on-year terms, of course, the outcome in the first quarter, 8.7%, is not at all bad. But a 22% contraction in quarter-on-quarter terms really does reflect some of the difficulties the country has had with oil production. Output from the Jubilee field has disappointed relative to expectations. And even though this was offset by higher gold output, higher output for other minerals in Ghana, that was not going to be enough to compensate entirely for what had happened with oil production. Nonetheless, that is still only a very small part of Ghana's economy. The economy remains relatively well diversified, and It's the strength that we see elsewhere that suggests that import demand is probably still very strong. But of course, it's not just import demand that has been pressuring the currency. It has been that psychological impact, the willingness to want to hold foreign currency because of fears that the Ghanaian cedi could depreciate even further.
All right, finish off for us very quickly by what do you think the risks associated with the economy right now are, and what the Ghanaian government or the central bank needs to do to restore confidence?
Well, a lot of what we've seen in terms of the FX volatility stems from perhaps the belief that in an election year we are going to see substantial fiscal overruns in Ghana. Now, whether or not that has been happening in reality is a matter of much debate, but clearly the authorities need to step in a way that's going to restore confidence. They've done well with the tightening measures so far, but if the currency should remain under pressure, even the extensive tightening that we have seen may not necessarily be enough. Despite recent comments from the Bank of Ghana suggesting that there may not be a need for further official tightening, we think that that is something that's likely to depend on the extent of stabilization that we see in the Ghana CD going forward.